This week on the Fundamentals Report, we look at one industry sector that will noticeably outperform the cannabis green rush. Investing in high-growth trend is proven to be one of the best ways to build wealth, and although the cannabis sector has proven successful for many investors, there is one industry sector that is set to significantly outperform cannabis. This same sector is the focus of giants such as Google, Facebook, Microsoft, and innovative content and technology leader Real-Time VR, trading as RLTR. Virtual reality is the highly disruptive technology which is quickly becoming part of all consumers' lives and will impact almost every major industry sector. Over the next few years, VR will begin to realize its potential with an estimated 171 million active VR users, generating nearly $121 billion in sales. For more information on VR and other stories, visit thefundamentalsreport.com.
Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered.
Welcome, everyone, to the GSMC Financial Podcast, brought to you by the GSMC Podcast Network. I'm your host, Andrea. Today, we'll get into which stocks did well and not so well in the advent of the strikes in the Middle East, some stocks to look out for in 2020, and how one of the top sports empires in the world may be starting to crumble. But first, I'd be remiss if I didn't mention how tension in the Middle East is affecting the stock market. Let's get into it. Wall Street, if you can remember, although it was only a couple days into the new year, did start 2020 on an upward swing, especially on the heels of the momentum of a strong 2019 until a U.S. military airstrike killed Iranian General Qasem Soleimani. Let me refresh your memory. In 2019, the S&P 500 shot up 29%, NASDAQ by 35%, and the Dow Jones by 22%, making for an historic year in the markets. The recent strikes, however, didn't help geopolitical landscape, especially in the Middle East, and sent oil prices climbing 4% to almost $70 a barrel, a 3-month high. Stocks declined following record highs set just before this news broke. For example, the S&P fell by 0.7%, while the Dow decreased by 0.8%, its largest drop in a month, according to Forbes. As you can see, these numbers are relatively small, and the American market bent but didn't break. Some entities even benefited after this news broke. For instance, something that's been considered a safe bet generally, gold went up by 1.7%, its highest jump in 4 months. Bitcoin increased by 5%. And in fact, some experts are saying now is the time for Bitcoin and other cryptocurrencies alike to really prove what they're worth in terms of being a viable global currency. They're saying the geopolitical unrest and the potential for a volatile market is really its time to prove itself. So watching Bitcoin and other cryptocurrencies may be something worth your time in the upcoming months. Concern over Iran's retaliation, however, is likely the reason why sectors like cybersecurity, airline, defense, and energy all saw a jump in share prices and sales. Also, big name stocks like Apple, Tesla, Facebook, Alibaba, and Microsoft also increased. So what does this mean moving forward? Well, Iran's foreign minister Javad Zarif took to Twitter shortly after the strikes to call the killing, quote, an act of international terrorism, end quote, and described it as, quote, extremely dangerous and a foolish escalation, end quote, warning that the U.S., quote, bears responsibility for all consequences of its rogue adventurism, end quote. So what does that mean? Well, analysts fear that Iran will retaliate by attacking oil infrastructure of American allies in the Middle East, namely Saudi Arabia. If that happens, it would undoubtedly mess with the global oil supply chain and likely drive prices up even further. Not to mention, Iran was responsible for cyber attacks against American businesses in the past, notably big banks back in 2012 and 2013. And they do have the infrastructure to repeat this, according to CNBC analysts who say that Iran's cyber capabilities are on par with those of Russia, China, and North Korea. So this fear of retaliation is really what could make an impact moving forward because, as I alluded to earlier, it could make for a volatile market well into the year, according to analysts, and anything that disrupts consumer spending, of course, is going to negatively affect the economy. However, generally speaking, this fear doesn't appear to be very high, at least at the moment, according to CNN's Fear and Greed Index, which is basically a gauge of which emotion is currently driving the market. The market is running on what they call extreme greed with a score of 93 out of 100 at the time of this recording. So it seems that there is an overwhelming feeling that tensions will ease over time and that this isn't going to erupt into World War III. Other positive news to look forward to in the next few weeks. There has been progress in trade relations between the U.S. and China. President Trump announced that the Phase 1 pact between the countries would officially be signed on January 15th, and that he'll later head to Beijing to start the next round of negotiations. The larger impact of that is that reducing some of the trade tension with China would take some of the pressure off of international tariffs, which would ultimately help global markets. Now, we talked about briefly some of the companies that did well amidst these strikes. One of them benefited significantly, making money for some, but losing money for others. Now, what does that mean? What am I talking about? Well, the company specifically that I'm referring to is Tesla. Now, this part isn't necessarily related to the strikes. It's merely anecdotal and coincidental that it did well in this time. However, the Model 3 sedan Tesla delivered a record 112,000 vehicles in the fourth quarter of 2019, and the stock closed Friday at its all-time high, coming in at $482.98 a piece, lifting its valuation to just under $80 billion, more than double that of Ford, just to put it in perspective. Plus, the stock could stay on the rise with the release of its latest crossover SUV, the Model Y, expected to be released this summer. Not to mention, the demand for electric vehicles is constantly increasing, especially with the consumer base, which is focused more and more on sustainability and eco-friendliness. Now, Tesla CEO Elon Musk believes the Y will outperform the S, X, and 3 in sales combined. And investors are really taking note. They're starting to believe that Tesla is coming into its own, especially since it lacks any real competition. Case in point, sales of the Chevrolet Volt, which is also fully electric, dropped by almost half at 47% in the fourth quarter and down 9% for all of last year. Tesla has also started global expansion with the recent opening of a factory in China, the biggest auto market in the world, by the way. Their production company in Shanghai, where car battery production began in December and assembly will begin any minute now. They've also announced plans to expand into Europe with a factory near Berlin, which is, oh, by the way, the home of BMW, Daimler, and Volkswagen, all of whom offer electric options that pale in comparison, at least in terms of demand. Now, Gene Munster of the venture capital firm Loop Ventures stated in a Bloomberg article that Tesla is on pace to meet Wall Street predictions for this year. Analysts are predicting 463,000 vehicle deliveries for 2020, which is up 28% from last year alone. Not everyone believed in Tesla, though. CNN reporting that in the last 7 months, Tesla short sellers have lost a whopping $8.4 billion. That's according to financial analytics firm S3 Partners. Now, what does short selling mean? Well, essentially, those sellers bet that the price of a stock is going to drop, almost like betting against a stock. But if the price goes up before they can cash out, they have to buy the stock at the higher price, which means that if they bet wrong, they lose a lot. And that is exactly what happened with Tesla. The $8.4 billion, by the way, is more than any short losses on any other company. After the break, we'll discuss more about short selling and how short stocks didn't quite come up on those who bet against Tesla this year and maybe even beyond, but could work in the favor of another company. Stay tuned.
This week on Under the Radar, where we identify publicly traded companies with incredible upside potential, we examine the high-growth functional beverage sector, with the likes of Pepsi and Dr. Pepper Snapple investing big to offset declining soda sales and acquire the small companies making the healthy drinks today's consumers demand. There has never been a better time to capitalize on the red-hot functional beverage sector. From vitamin water to healthy tea drinks, it's emerging companies with unique product concepts and strong revenue growth that are considered the best candidates for investment. Companies such as publicly traded Glucose Health, ticker GLUC, which makes diabetic-friendly iced tea sold nationwide in 1,800 Walmart pharmacies. With impressive triple-digit year-over-year revenue growth and expanding product lineup, savvy investors need to take an in-depth look at Glucose Health. Do your research now and be among the first to recognize this opportunity. For more information on Glucose Health, visit us at undertheradarminute.com.
Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered.
All right, welcome back. Before the break, we got into how Tesla was crushing it in the fourth quarter of 2019 and looks to do even better in 2020, and how that lost a lot of money for people who bet against them, namely short sellers. So just to dive deeper into that, we said that Tesla's short sellers lost way more than any other company, the second biggest being Apple, who were out $6 billion compared to Tesla's $8.4 billion. But I just want to put that in perspective to you. Apple is much larger than Tesla, and short positions on Apple are way smaller. As in, short selling Tesla accounts for about a fifth of its stock sales at 21% compared to just 1% for Apple. So just keep that in mind. But still, Tesla short sellers lost $700 million in just the first 2 trading days of 2020. And although some are getting cold feet, many are still betting that the market will turn against the company. Although, as I said earlier, Wall Street expects it to have another big year so long as the Model Y does as well as Tesla thinks it will. That remains to be seen, but in the meantime, Elon Musk is certainly reveling in the pain of short sellers. It's no secret that he is not friends with any of them, even considering making Tesla private not so long ago, specifically to avoid shorts who he believes deliberately try to hurt the company by driving down stock prices. He even tweeted a shot at a nemesis of his, David Einhorn of Greenlight Capital, back in November, saying that he'd sell him a, quote, small gift of shorts to help you through this difficult time, end quote. It's good to see that Elon Musk hasn't lost his sense of humor, and although there's no word on whether or not that gift is en route, since he is yet to comment on the recent numbers, but he may just be letting the money speak for itself. I want to stay on this topic of shorts. If you were thinking of buying Peloton to help you with that New Year's resolution, you might want to think twice. CNN says short seller Citron Research expects Peloton to plummet almost 85% to just $5 a share. Now, it's not quite that low yet, closing on Friday at $30.60 a piece, which is actually up 2.89%. But things haven't really been looking up for the indoor cycling company, especially after some social media backlash over an ad it ran over the holidays. Now, if you haven't seen the commercial, you can do a quick Google search, but the gist of it is that a husband surprised his wife, who is a young mother, with a Peloton bike for Christmas, and she basically creates a video diary of herself using the bike over the course of the year and kind of just video documents her progress. Now, as I said, the commercial was not well received, as many believed it to be sexist and that the husband was body shaming his wife with the purchase. Ironically, and intentionally or not, their newest commercial actually features a man on the bike with his young son looking on and says that Men's Health is calling it one of the best cardio machines, something to that effect. I digress. Citron Research is putting Peloton akin to GoPro and Fitbit, hot at first, but prove themselves to be one-hit wonders thanks to competition. Google is currently in the process of buying Fitbit for $2.1 billion, which works out to $7.35 a share, roughly 85% below its peak price back in August of 2015, which was shortly after it went public. Citron's report says that when you really look at Peloton's business model, there's nothing special about it, nothing that would give it a competitive edge or set it apart from similar products. In fact, Peloton shares have dropped about 12% in the last week, just barely higher than its initial public offering of $29 when it went public in September. Citron further goes on to say that competitors are making comparable bikes, but ones that offer better function and affordability, adding that Peloton's $2,300 price tag is excessive, and that doesn't even include the monthly membership fee to access its classes. Plus, there are variations just as good from more experienced companies such as Nordic Track, Proform, Echelon, and Bowflex, among others, some of which are even willing to let go of the bike for free with the purchase of the virtual class subscription. Now, Peloton founder and CEO John Foley, though, is trying to refute the claim that the company is a one and done, as apparently they're slated to release their version of a treadmill, which the company expects will increase revenue. And though he didn't really get into much detail about what the treadmill will entail, he did say that the consumers will want the Peloton version because of the unique features that it will offer versus a traditional model of a treadmill, which are merely what he calls, quote, clothes hangers and, quote, dusty. Citron, though, still believes Peloton is overpriced, especially compared to other successful subscription-based business models like Planet Fitness, Stitch Fix, Netflix, and Spotify. Now, take this information with a grain of salt, of course. The report is coming from a short-selling company, so of course they are betting on Peloton to do poorly if that's what they're predicting, because otherwise they're going to lose a lot of money, as we saw in the previous example with Tesla. But it is true that there are other models on the market that are similar and might offer more variety. For example, there are commercials on TV now for Bowflex's version of the bike. And Bowflex not only shows images of the bike, but of their other exercise machines and other virtual class programs, using their edge over Peloton and other competitors as variety. Whereas Peloton, for now, remains to be seen with the advent of this apparent treadmill, but for now, they're a one-trick pony. They just have the bike, they just have the membership that you need to ride the bike, or else it's essentially useless. You're just riding indoors, unless you put on your own music, which I suppose is possible, but then again, that goes back to why would you spend $2,300 on an indoor stationary bike when you can probably get an outdoor bike for the same price and it'll offer more functionality, because of course you can use an outdoor bike indoor. You can make it stationary in virtually all seasons. Bowflex, as I alluded to earlier, is offering variety as their edge. Regardless, even if Peloton is a fad, it and other home fitness companies like Bowflex are starting to disrupt the fitness industry, according to Gold's Gym CEO Adam Zaitsev, because it makes people more aware of different options, not to mention the convenience option of on-demand fitness, especially in this hustle culture that we appear to be living into. Everything is about convenience, making things more convenient, reducing commute times, doing things from home, which certainly the at-home fitness industry is capitalizing on. However, Gold's Gym, which has been in business for 50 years and has 400 plus locations across the US, has been a mainstay because they are trying to capitalize on evolving, following trends, and building communities. When we come back from the break, we'll talk about making some money in 2020. There are a few stocks that analysts have pegged as possible big winners in the next year to come. Stay tuned. This week, we take a look at what is considered by many to be the next extreme high growth sector. Quickly becoming part of all consumers' lives and beginning to impact almost every major industry sector is virtual reality/augmented reality. Predicted to bring us the most disruptive technology since the cell phone and impacting a wide array of core industries, including entertainment, healthcare, education, retail, military defense, marketing, manufacturing, and media. Nearly every major player in the technology space have invested heavily in VR/AR. This includes the top social media company Facebook's purchase of Oculus for $2 billion. Their firm commitment to focus on virtual reality recently launched Facebook 360, which allows all 2.2 billion and climbing active Facebook users to experience and share virtual reality content. YouTube has also invested deeply in VR, now prioritizing VR content over other content to its 1.3 billion active users. And it does not stop with social media, as Samsung, the largest manufacturer of cell phones worldwide, has over 1 million users per month on its Gear VR headsets. Sony PlayStation launched VR games on its PlayStation 4 console, as did Microsoft on its Xbox One platform. Other standout tech companies invested include Google, IBM, Intel, HP, Foxconn, and other smaller but notable companies such as LG and HTC. In fact, 8 of the top 10 tech companies in the world are invested in VR/AR. Whether you've strapped on your favorite VR headset or just seen one of those 360 videos on YouTube or Facebook, chances are you've already sampled virtual reality. From entertainment to educational applications, VR has finally made the transition from science fiction to everyday life and is set to massively expand. Per projections from Greenlight Insights, VR is set to reach 171 million active VR users, generating nearly $121 billion in sales in just a few short years. Analysts at top brokerage firms such as Goldman Sachs are aggressively recommending virtual reality stocks, likening the opportunity to the advent of the television. Piper Jaffray described virtual reality as, quote, the next mega tech theme, end quote, going as far as comparing the state of virtual reality today to that of mobile phones 15 years ago. Investing in high growth trends has proven to be one of the best ways to build wealth. VR/AR can be considered to be the highest growth sector we have seen in many years and is the focus of publicly traded market giants such as Google, Facebook, Microsoft, and Sony, as well as smaller public companies such as innovative content and technology leader Real-Time VR Trading as RLTR. Do your research now on virtual reality.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year, to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
Welcome back to the GSMC Financial Podcast. Before the break, we talked about how some companies might not be doing so well, according to short sellers in 2020. However, there are three that analysts have pegged to be possible big winners this year. According to TipRank's stock screener tool, they found three stocks that analysts believe could do very well in the year to come, all three with a, quote, strong buy consensus rating. You can find and use that tool at tipranks.com. So let's get into them. The first is Zix Corporation. This company provides email encryptions and cloud-based security solutions to clients, most of whom are in fields that deal with highly sensitive information like government, healthcare, insurance, and financial regulation. So here's what you need to know. Last year, the company acquired AppRiver, a cloud-based cybersecurity provider, for $275 million. AppRiver specializes in small and mid-sized businesses, which will then complement Zix's specialty in big business, which allows for cross and upselling. Plus, AppRiver is expected to be a big piece in the company's overall revenue growth in 2020. In fact, Dougherty's Catherine Trebnick, a Wall Street analyst, believes that Zix trades at a discount and is actually undervalued compared to similar companies. The second company to look for as a possible moneymaker in 2020 is Upwork, Inc., an online job market that allows employers to search for freelancers, and freelancers, especially creatives like graphic designers, writers, video editors, and the like, can also find projects to work on. The share did have a tough 2019, losing 40% of its initial price when it went public in 2018. However, it is expected to rebound this year, given that it's the largest company of its kind and the increase in people seeking to work from anywhere, so to speak, and it's only growing. BTIG's Marvin Fong expects the company's revenue to jump up 15% over the next 5 years. The third company is Rubicon Project, which is an online advertising tech company. Its automated platform is used by online publishers to automate the buying and selling of advertising, and its goal is actually to be the NASDAQ of digital advertising, according to the company itself. Now, Rubicon did well on its own last year, with its share price skyrocketing 119% over the previous year, but is expected to do even better in 2020 after merging with Telaria, another digital advertising leader, to create the largest independent sell-side advertising platform in the world. Plus, Rubicon shareholders are set to own 52.9% of the company's combined fully diluted shares, which are essentially the total outstanding common shares available after all conversions, like employee stocks. So there you have it. If you're looking to make a little money in the stock market in 2020, a few Wall Street analysts have pegged Zix Corporation, Upwork Inc., and Rubicon Project to be top sellers in 2020. Just want to switch gears a little bit for any sports fans out there. Of course, with the NFL playoffs upon us, we're seeing upsets, we're seeing underdogs winning, and to a degree that happened on Saturday with the Tennessee Titans beating the dynastic New England Patriots 20-13 in the AFC wildcard game, which when was the last time the Patriots were actually in a wildcard game? The Patriots are the 8th most valuable sports empire in the world, according to Forbes. Now, as I said, when was the last time you can even remember the Patriots in a wildcard game? Since Tom Brady has been their quarterback, beginning back in 2001, they've won 17 AFC East titles, played in 9 Super Bowls, winning 6 of them. They've been essentially the most dominant franchise in football, but arguably in all of sports. And that has, not surprisingly, cashed in for them. So in 2001, the Patriots were the league's 9th most valuable team, according to Forbes, worth $524 million. Back then, it cost about $285 for a family of 4 to go to a game at Gillette Stadium. Now that takes into account tickets, food, souvenirs, things like this, which was 22nd in the league. So not expensive when you consider a 32-team league. However, now the cost of a family of 4 going to a game is $645, which is the 3rd highest in the league. So they have absolutely skyrocketed and jumped up that list of how expensive it is to attend a Patriots game. But people are still going because it's sold out 281 consecutive games, which is the 4th most in the NFL. Now let's go back to the 2018 season. The Patriots generated $240 million in operating income, second only to the Dallas Cowboys. Now they're worth $4.1 billion and are the league's 2nd most valuable team. Now, what's really interesting about this and the fact that the Patriots lost was the evident decline in quarterback Tom Brady's play throughout the season, not just in the game. Tom Brady is 42 years old, said he wants to play until he's 45, which is unheard of in any pro sport, essentially. But given on the loss on Saturday night and the fact that the Patriots are not going to go back to the Super Bowl or even have a long playoff run this season, it's possible that it could hit Robert Kraft in the wallet. Now, let's not feel too sorry for him. He paid $172 million for the team when he bought them back in 1994. They're now worth $4.1 billion. I say that's a good ROI. Not too bad. However, what remains to be seen is if all those season ticket holders, which, as we said earlier, have significantly increased over the years, will they stay along with the ride? Will they stay along for the ride? They and sponsors, no less. The Patriots have been essentially a dynasty, especially with Tom Brady at the helm, but with his declining play, his age a factor, the fact that he's a free agent at the end of the season, and the Patriots have proved to be relentless in the past, meaning they are not really loyal to players who have given their heart and soul to the team. I know Tom Brady could be a bit of a different case, maybe a one-off case. However, don't be surprised if the Patriots don't re-sign him, because although he isn't playing to the level that he maybe wants to, maybe believes he still can, he is still going to demand a hefty price tag, and who knows if the Patriots are willing to pay for it. And if they are, who knows if fans are willing to come out to pay for it ultimately. So it'll be interesting to see if the Patriots' value then declines without Tom Brady and possibly without the backing of a packed Gillette Stadium Sunday after Sunday.
You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.
Meet Bob. Bob's a business owner with the next great retail product and is ready to market his product to the entire U.S. consumer market. Problem: Bob spent all his money developing and making the product and has no money to pay for advertising. Bob's bank says, go sell the product and then we may loan you money. Venture capital sharks want a majority percentage of Bob's company. Bob's not happy. Now meet Sue. Sue is celebrating the sale of her millionth unit on TV. She was also turned down for a loan from her bank, but she contacted Media Funding Group to fund her advertising campaigns. Media Funding Group provides funding exclusively for advertising campaigns using equity participation and revenue share models that, unlike bank loans, you do not have to pay back. If you have a great product or service and all you need is funding for a major advertising campaign, don't be a Bob. Contact Media Funding Group today. MediaFundingGroup.com.